Naturally, we here at the Real Estate Crowdfunding Show syndication in the digital age at gowercrowd.com are totally ahead of the curve. And so as soon as momentous events happen, we immediately marshal all of our resources, spring into action, and bring you the most important, actionable information to impact your real estate investments that you can use immediately. Hi, I am Adam Gower, and that is why, on time, exactly 2 months late, I'm going to be talking today about the impact of war on the commercial real estate industry in the United States. So what inspired me to do this podcast today, of course, was the US assassination of Qasem Soleimani at the beginning of January, when we nearly went to war with Iran, or it appeared like we might be. I called one of the top experts in real estate in the United States, Stuart Gabriel, economist, ardent realty chair, professor of finance, and director of the UCLA Ziman Center for Real Estate, to talk about the topic of how does war impact commercial real estate. So for the first time actually in several years of podcasting, I'm actually quite pleased to present to you today an episode as utterly fascinating as it is, with one of the foremost scholars in the world, that I truly hope will never, ever be of any use or value to you other than for purely historical purposes as you reflect upon a world without war, and so never need to wonder what the impact might be on your commercial real estate holdings. What you're going to hear about today is behavioral economics in times of war and terrorism, how Middle East oil impacts commercial real estate, the ways cyber warfare may impact commercial real estate, and a whole lot more about topics that we hope will remain irrelevant and purely hypothetical, of course. Another difference actually in today's podcast is that for the first time in this series, I'm not talking about digital marketing to raise capital for your deals. You can find out more about that if you want to, and how to attract prospects and turn them into investors predisposed to invest in your deals by signing up for the whiteboard workshop on the podcast page for this episode at gowercrowd.com, where I'll walk you through the entire system. No, today's episode is the first of a few similar ones that are in response to queries that I get from private clients actually, and also from investors. And in this case, I had, as you can imagine, a lot of questions about the impact of war on commercial real estate. And in upcoming episodes, we'll be talking about cannabis real estate, workforce housing, foreign investments in the US, and a whole lot of other very interesting subjects. All right. So let's get started with this little diversion from digital marketing for a few episodes with a discussion about the impact of war on commercial real estate with Stuart Gabriel, economist, ardent realty chair, professor in finance, and director of the UCLA Ziman Center for Real Estate. Professor Gabriel, thank you so very much for being with me today to talk about this very important topical subject, the impact of war on commercial real estate. And of course, it's a sorry subject to have to talk about, but it's very relevant, and I'd love to hear your views on this topic.
Dr. Gower, it's absolutely a pleasure to be with you. Always a pleasure to speak with you. Enjoy the work that you do, and this is an unfortunate topic for our conversation, but let's go at it. We are speaking in the context today of a U.S. strike on a terrorist-related military official in Iran, and some relatively limited retribution to date as promised by the Iranians. In some senses, there is an indication that the sides are standing down, although that isn't in the least bit clear, and we should not take much comfort from that, I believe, at this moment. So in sort of the assessment of warfare in commercial real estate, we can kind of put some bookends on the story. One bookend is perhaps the firebombing of London or of Dresden during World War II, and absolute annihilation of the physical structure of a city. And at a different sort of bookend, we can put very modern dimensions of warfare where we see increasingly, even in supposed times of peace, things like serious cyber attacks on corporate America or corporate whatever. So I would guess that the listeners here and you as well would presume that we are not facing another blitz of London today. Although the Iranians themselves may be more exposed with respect to actual physical damage associated with confrontation than in fact the United States is. And that of course has to do with a very disproportionate military technology and economic strength of the two countries. The fact that the US immediately will rule Iranian skies. The Air Force will have complete operational flexibility there, and major Iranian economic assets, if not military and nuclear assets, will be immediately exposed. So the idea that the Iranian oil export capacity in Basra will be exposed to a direct hit, I believe is a correct idea. Even there, we're not overly worried in terms of global economic consequences, as only 5% of global oil production comes from Iran and goes through that area, although it's completely plausible that we would see economic attack via the Straits of Hormuz and via the shipping of oil that could cause disturbance in global petroleum markets. But getting away from kind of massive physical attack, what would some sort of conflict with Iran look like from the perspective of the West, Western economic interests, and Western real estate interests? Well, there are basically 2 or 3 pathways. Pathway number 1, for the sake of simplicity, we'll call 9/11. And in pathway number 1, as you know, a major iconic global piece of real estate was destroyed in New York City. And of course, implications not only for very immediate indicators of real estate in downtown Manhattan, such as office vacancy rates, all the rest, but also economic implications in terms of the way that we factor terrorist events and related exposure into insurance that corporations pay and into bottom line to pro forma that now may incorporate much more significant insurance premium and the like. So there's a dimension here that relates to actual physical attack, which is isolated and terrorist related. And we've been told that, there are Iranian agents and cells operating in the United States that could be activated. They could be activated here or in Europe or in elsewhere, among other things, for purposes of terrorist activity and terrorist related real estate damage. So that's pathway number 1, again, to repeat, sort of a 9/11 type of pathway, although perhaps a more moderate version of that. Pathway number 2 is a more modern version of that. It's simply cyber warfare, and cyber warfare could hit easily major institutions of corporate America, as well as the US government. And in that particular respect, corporate America increasingly today needs to be totally aware and completely up to speed with respect to both cyber defense, cyber security, and related cyber relief. And that all is an exposure that corporate America is taking very seriously today, with redundancy in platform, with disaster recovery capacity. And again, that flows to the bottom line in terms of the cost of doing business. Would not necessarily have large-scale economic damage associated therewith, but certainly there's significant potentiality there. So those are a couple of the pathways. I'm going to stop. Is that okay? You said I could stop.
Yes, perfect. Right. So, okay, good.
You said I could stop anywhere and like recollect.
I'm so glad that you did. Take a break. You can now inhale.
Yeah, I'm trying to remember what number 3 was.
Huh?
Oh, number 3 was stock market and Archduke Ferdinand.
Stock market and Archduke for. Oh, that's right. Right. That's right. That's what it looked like, didn't it?
Yeah.
When Soleimani was assassinated. Right.
Okay. So a third possible pathway could be a generalized economic pathway that filters through to the real estate sector and to institutional grade commercial real estate and the like. And the historic example which is being discussed here in the context of the assassination in Iran, the Soleimani assassination, is that of the assassination of Archduke Ferdinand in Serbia as a pivotal sort of precipitating factor of World War I. And the interesting anecdotal note to that factor is that in the immediate aftermath of the assassination, there was not a perceptible financial market reaction. But actually some 3 weeks later, there was a market fall in the London Stock Exchange as traders came to recognize that the very deep and dark clouds of war were forming over Europe, and that war would involve major European powers, including the Austro-Hungarian Empire, Germany, France, Britain, etc. So there was some lagged effect there, and there are questions being asked currently about whether we're in this time frame of lagged effect. I can give you my own take on this, and my own take is that while we could be going to some form of active conflict in and around the Persian Gulf, in and around Iran, Iraq, Syria, potential attack on Israel, although I doubt that significantly, we are not going to World War III. And one reason we're not going to World War III is that there's no one out there who is going to fight the US over Iran. In other words, we're not going to see the Chinese deploy on behalf of Iran. We're not going to see the Russians deploy on behalf of Iran. But anyway, we see a conflict here where it's very disproportionate in terms of the capacity to use force, not to mention the fact that the US have imposed very hurtful economic sanctions on Iran. So Iran clearly is wounded. It's dangerous because it's wounded. It is an advanced technological society that is not without significant capability and capacity, but nonetheless, as I mentioned earlier, there's no answer to the US Air Force or to all of military technology that the US has relative to very obsolete technology on the part of the Iranians. So the Iranians really can't go that route. The route that they can go is the route of sending some missiles into US compounds in Iraq, to using their proxy armies, including the Hezbollah in Lebanon, or the Hezbollah in Iraq, or the Houthis on the Arabian Peninsula, or others, to attack US or Western assets. You know, the attack on the Saudi oil fields was an excellent example, now pinned on the Iranians, clearly of a attack meant to send a very deep and serious signal to global oil markets about risk, and so on and so forth. So in all likelihood, it's going to be that. And in all likelihood, there's more of that coming, that we haven't seen the end of this. And in all likelihood, there will be some form of US response. So we'll see how this set of back and forth goes. Again, the third pathway is a generalized economic pathway. So let's take the hypothetical here that we have an Iranian attack on Saudi oil fields again, or some such thing, and or Iranian fast boat attacks in the Persian Gulf or the Straits of Hormuz on global tankers. The guess is that that obviously will cause volatility in equity markets. It will cause volatility in global petroleum markets, some rise in oil prices. It's not clear that there would be the type of rise in oil price that would be extremely hurtful to the global economy based on the limited amount of oil that comes from that area and the fact that we could pump oil elsewhere. So again, there's no cataclysmic scenario that I think we're contemplating there. But in terms of this pathway and getting back to real estate, the pathway is the VIX pops up in terms of a higher level of equity market volatility. That higher level of equity market volatility has to do with uncertainty about a military tit for tat. It has to do with some disruption in oil supplies, potentially. It has to do with just uncertainty about the pathway of White House policy or of Iranian policy, and all those factors begin to seep into an equity market, which is already, in the words of some equity analysts, priced to perfection. In other words, stock prices are high relative to historic precedent, and they're very high relative to precedent now. So people are wondering how much higher they have to go relative to the downside risk. Well, we just have a new fundamental downside risk here. So how does that work again? Well, we could have some correction in the stock market that creates some downward adjustment in wealth. We could have that coupled with a cyber attack or a real terrorist attack that again creates high levels of volatility, again creates adjustment in equity and fixed income markets that are negative, that ultimately over some period of time with some transmission feeds into the real economy. In other words, feeds into the creation of GDP. And as it does, it potentially affects those who lease space in major office buildings, or those who take vacations in major lodging projects, or those who are thinking about buying a house, or those who shop in retail centers, or whatever it happens to be. And as we see net operating income of any of those projects begin to ease, there are property valuation implications. And now those property valuation implications obviously can be offset to some degree if we see some easing in interest rates. For example, if there was a monetary policy reaction in the form of easing in the context of turmoil, I think we're getting way ahead of ourselves here. And really, that's not even on the table. So
why is that? That's because rates are so low already.
One reason is that there's the primary reason is that there's, for example, in the case of the U.S. Federal Reserve, no justification at this moment for further changes in monetary policy, and the Fed has broadcast that very clearly. And the second is that for the Fed to get involved, the economic disturbance would have to be real and sizable to the extent that they were observing evidence in the economic tea leaves, in the economic indicators of some serious downside risk that was of adequate materiality to lead them to think about some monetary policy action. So I honestly, I put the probability of that at this moment at, very low single digit. I don't think we're nowhere near that at the moment. In fact, I'm not even sure why I'm mentioning it, but the point is.
Well, actually, let me just jump in if you don't mind, because this is a very important point, I think, that you make. So we're talking about the impact of war, but we're also redefining what war is, right? How that looks, and then extrapolating from that the impact on the economy, because that's the only way to really understand what the impact of war is on real estate, right? Because real estate these days there isn't a direct correlation between war and real estate. Buildings, with unusual exceptions, aren't blown up, right? I mean, we saw it in 9/11, it was, but it's different. It's the economy that drives the commercial real estate market. Right. So let me ask you this. This is where I was going with this. You talk about interest rates. So I think that's very interesting. If the economy, if NOI does start to go down and there is a depression in commercial real estate, then, quote, all the Fed needs to do is to reduce interest rates. But if there is a war going on somewhere, that potentially is very costly. And so the government needs to spend to finance that. So there's this counterweight that the only way they can borrow to spend is actually to increase rates. So at the same time as needing to increase rates to attract more borrowing, right, to finance a war, there's pressure to reduce interest rates. So how does that balance, do you suppose, in a wartime scenario?
Well, Adam, you bring up very good points, and I think again, what you and I are grappling with in this conversation is how do we define war? And I think the way you've just defined war is really, in some respects, a major conventional engagement that, at least historically, has been associated with a major demand shift that relates to output of goods and equipment and services and all the rest related to that war. My own personal opinion is that we would expect less of that at this moment, barring, again, a very, very serious, long-lasting major U.S. deployment back into the Persian Gulf, which I'm not sure anyone is quite talking about at this moment. Chances are they can hurt us in an unconventional way through either conventional terrorism or cyber terrorism, at the same way that we can hurt them, really with a lot of our already existing capacity on the table. In other words, we've got a lot of idle military resources, be they human manned aircraft or be they drone related aircraft. And all this is a matter of just positioning and kind of putting on go. But that said, your point is very well taken in a slightly different way. So here's a story. When we discount NOI to create a valuation of a property, there's this question of where that discount rate or whatever comes from. And that discount rate has two pieces. One is a risk-free rate, where that risk-free rate is driven in some measure by monetary policy and other such factors. And in an extreme form of a war-type situation, you could see a Federal Reserve intervention and you could see some downward drift in the risk-free rate. The flip side of that is that we have a risk premium that, of course, is sector and geography and all the rest specific. And the combination or the sum of the two, the risk-free rate and the risk premium, is the denominator in that discounted cash flow computation. Now, at the same time, and for the same reasons that we would see a decline in the risk-free rate, we would also see an upward adjustment in the risk premium because of uncertainty and volatility and all the rest that could be embedded in the risk premium. So it's possible that we could see effects of conflict in interest rates in different places for different reasons. And
so, for example, give me some for examples of that. What would that look like, actually? You think?
what would that look? What that would look like would be a situation. This is again an extreme situation. This is a situation where a monetary authority decides to take action because of granular, substantive information, economic indicators, economic tea leaves that show a real slowing in economic activity. In this case, the monetary authority eases and risk-free rates fall. The decline in risk-free rates, all things equal, or ceteris paribus, as we say in economics, should serve to boost property values, because the decline in the risk-free rate should translate into a decline in the cap rate, all things equal. But there's a footnote, there's a caveat. And the footnote is at the same time that the risk-free rate could be compressed, you could see an increased risk premium. And it's the combination of the two that form the discount rate or form the cap rate. And so this increment in the risk premium could offset the decline in risk-free rate so as to leave discount rates or cap rates constant. In other words, the commercial property sector would receive less or more of a de minimis boost from the easing of monetary policy than might be expected.
That's interesting. Let's unwrap some of the three concepts or the three phases or that you described to start with. Just a little bit more and chat about them, if you don't mind.
Sure.
As for the impact on real estate, because, you know, as I mentioned when we first connected, I've been doing a lot of work trying to find academic studies that talk about the impact of war in any form on commercial real estate. And the closest I've come is the impact during the Blitz, Hiroshima, right? And the return of the GIs after the Second World War. In other words, nothing for today. So what we're talking about is really de novo conversation, right? It's brand new. No one's really addressed this in any formal way. So you know what? It's an interesting conversation. So let's talk about cyber warfare from the first instance. Now, the way that I think of it, you mentioned cyber warfare on corporations and on governments. What I have thought about and think about in my day-to-day life is that here I am, Stuart, I'm sitting opposite you with my computer, on which is my entire world, right? My banking, my business, my primary and only form of communication, right? If you take my phone into account as well, if that went down, my world would stop functioning, especially if my banking stopped functioning. How would I buy groceries or gasoline or conduct the day-to-day activities? Now, that's pretty bleak to imagine that happening, but it's not. It's, you know, how far away is that from the potential of reality? If you've got a disproportionate military capability over a dangerous enemy, then the only way that they can fight you is an asymmetric, right? In asymmetric warfare. And so if we were to see cyber warfare in any way, let's say it's corporations or governments or credit ratings or infrastructure, how would somebody, well, look, we can't predict it, so you can't really do anything about it. There's very little you can do in terms of real estate. Like, you can't, in this conversation, we couldn't say, sell this or buy that, right? It's like irrelevant. If it was a stock market, you might be able to, because you can buy and sell, but real estate is illiquid, so it's difficult to sell. But let's talk about what ways cyber warfare could, in different ways, impact commercial real estate.
Well, you've articulated a very serious and major concern. And it's extremely broad-based. You know, the issues that you described certainly could have some effect on real estate, but they would be very broad-based in their implications. I mean, if you remember old-fashioned conflicts, you know, groceries don't get delivered to grocery stores, and gasoline doesn't get delivered to gas stations. And, you know, there's really a very basic set of issues additionally that need to be addressed. Do we expect those things in this particular instance? No, we don't, especially not in the United States. But could there be instances where, let's pick a name, Social Security Administration is taken down, and those who receive Social Security don't receive their monthly check or whatever? Certainly that's a possibility. And I think there, for you and I, this is a moment for learning. And the idea is that, very, very unfortunately, but very, very true, we've created a great dependency on all the things you've indicated, and we must be prepared. And you and I have very little insight as to the level of preparedness of, for example, federal government agencies or county government or state government or people that do municipal services or something like that. But across the board, this corporate boardroom focus on redundancy of platform, on disaster relief, on disaster recovery, on having every corporate executive and operative with an emergency laptop, with emergency power, with data on the cloud somewhere in Utah or Louisiana or Greenland or who knows where, where you can flip the switch, go to the auxiliary redundant system, and within 15 minutes, you're up and running. And this is simply part of our reality. So indeed, there's one message of preparedness from our conversation. This is the message. The day has long since passed with respect to a lack of focus on the importance of such preparation. So just as, you know, we prepare, like, for example, here in California, I'm not sure about your house, but outside my house, we have the big plastic garbage cans with earthquake supplies. And we have another metaphorical plastic garbage can that relates to redundancy and clouds and cyber preparedness. And both are tremendously important.
So here's what I'm trying to extrapolate. It's really difficult, Stuart. I mean, it's really difficult, but thinking about commercial real estate, if one was to think about, you know, where to invest in commercial real estate, where there may be opportunities considering this kind of development, one might be, for example, buildings that house the backup systems. Now, if they're in Iceland, there's not much you can do in the US, but for data centers, for example, or critical backup warehouses, wherever they are, that offers an opportunity, doesn't it? Because the more often we are exposed to these crises, like 9/11, God forbid, right, or Soleimani, and et cetera, the more people become aware, the more they demand these services, the higher the demand is for that kind of, the kind of real estate that houses that kind of service.
You're absolutely correct, and that is one particular play, and potentially a very useful play with respect to funding such services and creating equity value and creating layers of protection and all the rest. I'll mention one other thing. you talked about evidence of impact of war on commercial real estate, and we spoke mostly about the unfortunate events of Dresden or London or Hiroshima or whatever. There was a significant period of time post 9/11 when tenants and investors shied away from trophy real estate in major global economic centers. Mm-hmm. So the idea of being an investor in a World Trade Center in a modern, dangerous world where the World Trade Center could be a target was something where people were shying away for a while. So major visible and even visceral indications of U.S. prominence and power that are real estate related in our major metropolitan areas are places that, unfortunately, based on some limited history, could be targets for terrorist activity. They represent the symbol of U.S. economic dominance, and for that reason are more important than just their simple real estate value.
Yeah, exactly. All right, so let's segue from that actually to a different kind of impact on commercial real estate. And this is, again, more economic, of course, but after the events of 9/11, I recall there was an immediate slowdown for vacationing, that people stopped traveling. In fact, you alluded to this before, that hospitality industry was negatively impacted as a result of that. So it was the perception that people had of danger and of threat and of economic downturn as a result that caused them to shrink in. There's another area, actually. So that's one thing. So that's an area to shy away from, right? Would be if you think that there is war of any sort that will prevent people from going out into public areas, right? And staying at home. So one would be hospitality. Another one is, when I was in Japan, I built movie theaters for Universal Studios. That's what they hired me to do. I built a chain of movie theaters. I recall that people sought entertainment. They were so resistant to the bad news that they were hearing that their instinct was to actually spend more on those things they were spending less on before, just to distract themselves from, the angst of war. So what are these are a little bit more more tangible, right, ways that commercial real estate can be impacted? Do you want to chat about that for a few minutes, those ideas?
Well, you're reflecting, I think, in a very interesting manner on many dimensions of, what Keynes called animal spirits, which is embodied today in something called behavioral economics or behavioral finance. And it's a critically important dimension of what we do as academic economists, and an increasingly important dimension as we seek to analyze regularities and behavior that have economic consequences. Now, let's take a couple of the examples that you cited. The 9/11 event was an event about air travel in terms of the way the event was perpetrated. And even at one point in 9/11, the entire air traffic across the entirety of the United States of America was grounded. So, and clearly, given, planes crashing into, major office towers in New York City and into the Pentagon and into a field in Pennsylvania and the like, an animal spirit arose, a fear that related to air travel, certainly in the immediate aftermath of 9/11, as we didn't really understand who these people were, where they came from, was this going to be replicated, were there a bunch of other bad guys out there waiting to do it again next week or the week after, etc. So, and that coupled with the fact that any event of this sort creates high levels of uncertainty, creates maybe downtime for business or for economic activity, depending on where and what the event is about, can create some uncertainty about an economy that's growing at a certain rate, and there may be some, as we talked about earlier, some modest attenuation or shock to growth. There was certainly a shock to growth that related to 9/11, had some lasting effects, as well as, of course, some bounce back. And all of those, everything that's embodied in those animal spirits gets translated into the economic realm. So just as you say, if you seek more distraction in the form of close by entertainment, if you seek more comfort in the home, if you seek less travel to far-flung beautiful areas that may be exposed. So if you recall, there have been terrorist events in the most beautiful areas of Java and Indonesia or wherever it is. So all of a sudden, exotic, amazing places become scary. So unfortunately, we live in a world, I believe, where this has become a regularity. And depending on how this interface with Iran goes, could be more of a regularity in coming months than less of a regularity. That will influence travel. It'll influence travel to the Middle East. It'll influence travel to anywhere near the conflict zone. And let us only pray that there isn't an effective execution of a terrorist event, cyber or otherwise, somewhere closer to home.
Stuart, you have a few more minutes. I heard you slightly wrapping up there. It was quite a concluding sentence, but one more thing, if you don't mind. I'm interested in, and if you will forgive the pun, I'm interested in talking to you about the impact of warfare, particularly in the Middle East, on commercial real estate as it pertains, drilling down on, that's the pun, on oil. I, of course, immediately sprang into action and bought oil stock that day, which has now gone down. Right, I was behind the curve. And you actually said that there was very little, because, of course, oil drives the economy, right? If oil and gas prices go up, and it kind of has this psychological, this behavioral, economic impact as well on how people react if they're spending more in their gas tank, etc. But you mentioned that there was likely to be limited impact on oil. Yet my thought was that if they shut down the Straits of Hormuz, even though Iran may only produce 5%, doesn't 25% of the world's oil go through? And so what's the impact actually, do you suppose, if oil prices were to spike? How would that impact, again, commercial real estate, and in what way, if at all?
Well, so Adam, you asked a question where there could be so many ways in which that particular oil price spike could kind of come home, so to speak. So, there could be a brief disruption, a brief spike, and that could be, oh, I see you have a friend there.
Sorry about that.
No worries. I interrupted myself. Looks like a very nice friend.
He is a very nice friend. Yeah, I think he wants to go out. He's going to have to wait.
Okay. So we live in a world where the dependency on oil remains, but it is not what it was. And there's been some dimension of diversification that should be helpful in a sort of cataclysmic event. We live in a world where there can be increased pumping from the Saudis, or from North America, or from Russia, or from Venezuela, or somewhere else in the event of cutbacks from the Middle East and the Straits of Hormuz. We live in a world where I would imagine quickly, to the extent that there were attacks in the Straits, there would be rather severe implications for those undertaking those attacks. So I'm not sure that those attacks in the form of material attacks would be ongoing for an extended period of time. They may be perpetrated over a week or two or something like that, but there would be implications certainly for those attacks. Now, if it were back in the day, let's take back in the day. Back in the day, for your purpose, I believe, in asking this question, is 1973.
Yes, that's exactly what I was thinking.
Is the formation of OPEC,
right?
The Organization of Petroleum Exporting Countries,
right?
And the creation of an oil cartel, which then jacked up prices by 2 or 3 times and resulted in significant gas scarcity, lines outside of gas stations in the United States and around the world, and what we call a cost side price shock to the US economy, to Japan, and to other major nations around the world. As, for example, take Japan. The OPEC event was extremely costly in Japan. They have no access to petroleum other than through imports. The imports skyrocketed. They brought import-related price inflation. They brought a tightening of monetary policy, higher interest rates, and a slower Japanese economy simply because of the magnitude of the oil price shock. That's kind of the extreme scenario that you're referring to here. And my guess is that we're nothing close to that here again, like just not even anywhere close.
Really?
But could there be a week or two of excitement in the Persian Gulf? Without question. Could there be damage on all sides to oil infrastructure production? Without question. Could we, in an extreme case, take out Basra, which is the Iranian oil producing facility? Without question. What's the issue with Basra? Well, we already have major sanctions on Iranian oil exports, and a lot of what they do exporting is absolutely under the table, with tankers that bear weird flags and oil that gets transferred at night, below the radar screen, literally. So it's not clear, again, in terms of getting to materiality here, the example that we gave of an oil price shock that is of sufficient magnitude or durability that it relates to a higher interest rates, monetary policy that pertains there too, that because of higher inflation and ultimately slower economic activity, I don't see us being there.
Well, thank you. I hate to admit, I do remember 1973. Actually, I do remember the oil shock. And I remember lines to the gas station, and it was a big deal. I was only a little lad.
So do I.
Yeah.
I would not like to see those days return.
No, exactly.
We didn't talk about something here, Adam. And I don't think either of us are military experts, but there's this thing called nuclear power in Iran, and it's literally the only real chip that they have. And I think that for sure would be a target. If things really heated up, I think at the end of that heat, they would not have the nuclear capability. I do believe that this particular way that Iran is making the world crazy with respect to nuclear arms could go away if there was real conflict.
Yes. And then just tying back into that kind of ties back into the whole everything we've been talking about in terms of the various ways that it could impact the US economy.
Yeah.
I'm sorry, not just, yes, the economy, and through that, and it could impact commercial real estate.
Yeah.
It's like a black swan, right? I mean, it's a black swan event that you can almost predict, would you say? In a way?
Perhaps. I think what's super interesting here, there are a lot of interesting elements. One is that Iran is not, it's not the Houthis. This is a real country with real technology, with a lot of people and real capacity. And so this just doesn't get dismissed. And they do have the capacity to do real damage. And I think, given everything we've discussed, the way they would do it would be either cyber or through conventional terrorism, if there is such a two words that can be put together. On the other hand, and they have staying power, and they have, they have a set of rulers that aren't subject to impeachment and re-election and all these different things. On the other hand, they have their own internal strife, as we've seen in recent months. I mean, they had to jack up oil prices in Iran, and there was like open warfare in the streets. So people didn't care about anything except that, they couldn't drive their cars, and that it impacted them very adversely and very directly. So they're not, they have their risk factors. We have a very big risk factor in a very unstable president, I think. A guy who doesn't have careful policy making and, is very morally compromised, because most everybody thinks that a lot of what's going on here has to do with distracting people's attention from impeachment. But okay, set that aside. I mean, I think most people in the United States also believe that Soleimani was a really bad guy and was doing bad things for a long time against the U.S. and U.S. allies. So not sure how many people in the U.S. are upset that he's gone. But what I was going to say is that we're exposed cyber, we're exposed terrorism, we are somewhat exposed economically. They are exposed massively.
So, and also you mentioned the nuclear issue. So right now, as we sit here today, you and I, we are in a kind of a simmer, right? It's the crisis was averted. The administration, both sides took the off ramp, right? But there is nevertheless a proclamation by the Iranians to continue their nuclear research and expansion. That is the heat under the simmer, right? Yeah. And that, if anything, is something to keep a close eye on if you are anticipating any kind of major events over the next few months.
I have the feeling that the Trump administration and many others around the world would love nothing better than a real legitimate excuse to take out their nuclear capacity. And I don't think too many people on either side of the political spectrum would be too upset about that outcome. And I hope in your opinion, I didn't bring politics into this interview, because I certainly was not intending to. You and I are just sort of talking now.
I stay away from it as well, like the
plane. Yeah, I certainly would be one of the least people upset if we took out their nuclear capacity. They've been blackmailing half the world with that nuclear capacity for too long. But I just think it's very disproportionate here. Well, I'll say two things in closing. One, we can hurt them very badly, very directly. And I think they know that. I mean, the technological chasm is just so great. I mean, we can destroy their nuclear capacity tomorrow. We can destroy their oil fields tomorrow. I mean, but they can also hurt us some too. But just the second thing, you said both parties took the off-ramp. I'm not at all sure that's true on either side. I think the threat is still really alive and well from Washington, D.C., and purposely so. And I also believe that they're not done with us. You know, I would be shocked if they were. This is the Middle East. This regime is the legacy of the Ayatollah Khomeini. This is a regime of radical Islam that foments terrorism around the world, you know, anywhere they can. And they're not done. They haven't decided that. We've just knocked off the second, you know, most revered person in the country. And we dropped a few bombs in the desert, you know, near some American bases. I don't think they're done at all.
Well, you know, I hope.
So you might get to air the interview.
Well, you know, I was actually thinking maybe I will anyway, because you know, what comes out of it more than anything is that we really don't know, right, how things are going to unravel, and the kind of the question that I'm left with still, which is what's so fascinating about trying to extrapolate anything from this from a commercial real estate perspective, is let's assume, hopefully it's a bad assumption, but let's assume that it does go all the way to some direct conflict, particularly if the nuclear thing doesn't go away and we end up hitting them. You know, that's the full conflagration. Is that good or bad for commercial real estate, right? I mean, traditionally, war, I've read, is good for the economy. And if it's good for the economy, then doesn't that imply that real estate will do well? On the other hand, there's what you've called the animal instinct, the behavioral economics, the way that people shrink back that will impact certain types of real estate, perhaps over others.
Yeah, I mean, one reason you might have, I would need to go back and look at this, but here's one take on World War II and commercial real estate, which is that resources were fundamentally, disproportionately and materially redirected from normal economic activity into the war effort, which meant that there was a significantly diminished supply of real estate across the spectrum of real estate development activities, significantly diminished home building during the Depression and during World War II, as well as anything that we would consider at that point in time to be institutional grade hotels, office buildings, retail centers, etc. So part of the reason for some upward movement in valuation post-World War II has to do with the fact that you have a surge in demand related to returning GIs, building families, expansion in civilian employment, etc., with supply that's been limited over a very long period of time owing to resources that were put in other places, put in the war effort, etc. So we don't know, we have to examine the fundamentals of both the supply and the demand sides to get to anything that relates to valuation, of course. And that's part of the key here. We've been talking a lot about the demand side and animal spirits. We haven't talked too much about the supply side.
Professor Gabriel, let's put a line under it there. I'll go ahead and edit this into a series of short videos and give you the opportunity to review everything as we discussed beforehand. And then I will distribute it and invite comment. And as time goes forwards, if you don't mind, hopefully we'll have nothing to talk about. But if we do, perhaps you'd be kind enough to revisit with me at the time.
Well, I'll say two things. Of course, yes. I mean, it was, people ask me to talk about this or that, and oftentimes it's really boring real estate topics that, whatever. But this was a really intriguing topic. So I enjoyed meeting you more, meeting you online, so to speak, and having this conversation. It was really fun. I kind of, maybe as you did, we just kind of made it up as we kept going.
This is an untouched area.
Yeah.
Seriously,
yeah.
I've really looked hard and spoken to a lot. No one's really examined it.
Right. Remind me though, Adam, what's your distribution mechanism? Who's going to go see this once I kind of say, okay?
Okay, so there are two primary forms. One is I'm going to actually put it in my podcast. So my podcast goes out, across all podcast channels. But the real drive is that I will create a bunch of content. This is what I do these days. I'll create a bunch of content. You've very generously spent an hour with me. I'll spend a lot of time now editing this into various forms. So there will be at least one written article that I'll create from this. There will be a series of short videos that I will also kind of sound bites. And then I'll try and create what I call notable quotables, which are quotes from you and possibly even from me. I'm not sure I said anything very clever, but I'll create those. Now, all of those pieces of content will go out on social media that will point back to the conversation that we had. I'll create a page on the website. So that will create visibility and traffic. And then the third way, if that is the third way, podcast, social media, the third way is I will also email it to a list of about 35,000 commercial real estate professionals that are my close personal friends across the country. And I'll invite them to listen as well, or at the very minimum, they will see it in their inbox. So it will create some visibility.
Very cool.
Well, it's a real pleasure. Really enjoyed our conversation.
Me too.
Yeah, I'm glad you did.
Happy again. Very happy to meet you, and we can do this again.
Yeah, let's do that. We'll be in touch. Thanks so much.
Thank you so much.
Right, that was Stuart Gabriel, Professor of Finance and Director of the UCLA Ziman Center for Real Estate, discussing a topic that, though fascinating one, we really do hope is never relevant. Remember, this is a short series of podcasts in response to audience requests that speak to key issues facing the world of commercial real estate. So if you're missing learning about digital marketing, fear ye not. You can still go to the podcast page for today's episode, where you can learn all about it by signing up for the whiteboard workshop, where I'll walk you through the whole system that we are building for private clients, how to raise money for your deals online. You can access that at the podcast page for today's episode at gowercrowd.com. All right, that's it. Thanks so much for listening, and thank you, Professor Stuart Gabriel of UCLA, for your time today. It was a real pleasure talking to you. That's all for this episode. I'll see you next time, and for now, this is Dr. Adam Gower signing off.